Hello and welcome to Macros with Mythili, the ET Now show that usually takes a hard look at major macroeconomic developments in India and overseas. But it's that time of the year when one looks ahead and tries to make intelligent and informed predictions about how the next year is likely to unfold. And since this is a program that looks at macroeconomic developments, we're going to try and read the tea leaves for you with one of the best macroeconomic brains in India, Chetan Ahya, Managing Director Morgan Stanley. Welcome to the show, Chetan.
My pleasure.
I know I said we're going to try and get you to do some crystal ball gazing for us, but since where we finally end up is always a function of where we start from, how would you sum up the present macroeconomic scenario, global as well as Indian?
Well, I think globally what we would describe the scenario as is one which is we expect faster inflation and fatter tails, i.e. that we do see pickup in inflation in developed world after 8 years of credit crisis where inflation has not been reaching central bank's goal of 2%. We do expect that to now be met over the next 12 months in DMs. At the same time, we do see that the risks in developed world as well as emerging markets are now higher than before, and that's why we say fatter tails. And the risks are coming in from the fact that we have risk of protectionism out of the US trade policy, we have political risks in Europe, and then we also have uncertainty in the outlook of China. And moving on to India, we think that the story of constructive growth recovery is still intact. We do think that in the next 2 quarters, i.e. the quarter ended December and March 17 quarter, growth will be affected by the currency replacement program, but after that we should get back on track with a gradual recovery in growth in India.
Yes, Chetan, you've summed it up beautifully for us. And yes, there are many ifs and buts. But you've said that you see the risks as more now than before. So if I were to ask you a very simple question, does the scenario just described by you make you optimistic or pessimistic? Or is it that one must never start the new year on a pessimistic note?
Well, I think the risks are higher in the sense that the tails are fatter. If all those events materialize in the right direction, i.e. that the US government takes the right step of fiscal stimulus and does not have the protectionism measures, then it also brings the upside risks parallelly. So that's why we are saying that, it's fatter tails, so both upside and downside risks are higher than before. So on balance, we are constructive on global outlook. We expect global growth to rise to 3.4% in 2017 versus 3% in 2016. And the reason is that we do expect in this 2017 calendar year, both EM and DM growth to accelerate. EM will rise to 4.7% from 4.1% and DM will rise to 1.7 from 1.6. In fact, this will be the first year after credit crisis where both EM and DM will be accelerating. But we do want to highlight the fact that we do see fatter tails, i.e. that both upside and downside risks are higher because of the issues that I mentioned earlier.
You've said you expect global growth to increase to 3.4% in 2017. But the IMF in its last World Economic Outlook had lowered the GDP estimates from its April projections. And worse, it had said for the first time in 15 years, trade would actually grow slower than GDP. And though it was a bit more optimistic about 2017, it was barely so. Moreover, the two major developments since then, the election of Donald Trump and demonetization, are broadly negative. So what is your sense? Is the world a better place today than before?
So Mythili, I think for 2016 even we had reduced our forecast earlier. What I was referring to was the trajectory from here from 2016 to 17, and I believe that even IMF has an improving growth for 2017. But yes, they all reduced, including ourselves, for 2016 growth numbers because of whatever challenges that we saw in that calendar year. But going forward, we expect things to improve. And as far as India is concerned, look, if you just put the numbers or the drivers to growth before the demonetization even took place, what was happening is we had seen steady improvement in public capex, FDI, exports, and then private consumption. The leg which was not really supportive was private capex, and that we still don't expect to be improving in 2017. But all the other drivers to growth should come back as soon as the impact of currency replacement program is gone by the end of first quarter of 2017.
And do you expect trade to grow slower than GDP?
So trade has been significantly growing lower than GDP growth for some time now, and that's been the sort of post-crisis era that we have seen that some de-link between global GDP growth and trade. Number of reasons for that, but for the forecast purposes, even we are forecasting global trade to be lower than global GDP growth. But I think that direction again on global trade is improving from 2017 to 2016.
Even as the IMF had lowered growth projections for the world, it kept India's GDP growth unchanged at 7.5%. But that was before demonetization hit us. What is your takeaway from this? That growth projections are notoriously difficult to make? Or is it that growth projections are always hostage to being eclipsed by black swan events, and demonetization was one such black swan event?
So we are at 7.3% for March 17, so even slightly more optimistic than RBI. But I think as we have mentioned earlier in our work, that we really have problems dealing with the new GDP numbers in terms of having a sense of where we are versus where we were in the past. And so if we were to look at the old series, then on old series we expect GDP growth to be at 5.7% in March 17 versus 5.6% in March 16. And this 5.7 should go up to 6.1% in March 18. So I think that gives you a better sense of what is happening underlying relative to what we were seeing on numbers earlier than the market-based new series data, where we expect GDP growth to be at 7.3% for March 17. So for FY18, we're expecting GDP growth to be at 7.7%, and as I mentioned on the old series, we expect it to go to 6.1%.
Speaking about the Indian economy, between external and domestic factors, which one, to your mind, is likely to matter more in 2017, and why?
Well, I do think that domestic factors will matter more, because I think the external factors will be better, and we're already seeing signs of that in terms of trade improving, exports improving, and capital inflows have also kind of been stable. The real concern, I think, from domestic side we have is how much is the damage caused to the capex cycle because of the growth impact that we have seen on account of currency replacement program. Mind you that capacity utilization is still low, and what we were then hoping for is that we see further pickup in consumption and capacity utilization, and then the capex picks up. But now because of this growth impact for the next 2 quarters, you will see a delay in the capex cycle. So I think that is the key risk to our growth outlook as well, is that whether you will see capex cycle getting delayed too far back because of the damage we've seen on account of growth on currency replacement program.
And what about GST? What is your sense on when we will be able to implement it?
Well, we do expect GST to be a step which is in the right direction. However, we do think that the fact that the government has really not taken any risk on the tax rate for goods and tried to put 4 tax rates separately, trying to match the existing taxes for various goods, and at the same time there will be an increase in tax burden in the services sector, plus compliance will increase tax burden on some of the smaller sections of the economy. So effectively the neutral rate is probably lower than what the effective tax rate will be now under the new regime, and therefore the economy will be burdened somewhat higher by taxes. So we are constructive about the fact that GST is going to be implemented, but at the same time we do think that there has been some compromise in the way the tax rates have been taken up by the government, and not taking any risk in putting the tax rate a little bit lower. So this, in addition to the currency replacement program, is the other risk which will be sort of to be watched to growth, because if the tax burden is somewhat higher, then that might actually again delay the recovery in capex cycle.
Chetan, you spoke about GST as being disruptive in the short term. So what to your mind is the downside risk from both GST and demonetization? Are you as pessimistic as some of the brokerages that have reduced India's GDP growth pretty drastically?
That's right. So we do have downside skew to our growth estimates for India, while we in our base case are expecting acceleration. So the downside risk would be about roughly 0.5 to 0.75% of GDP growth.
Just hold your thoughts there for a moment, Chetan, because it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm discussing with Chetan Ahya, Managing Director, Morgan Stanley, what his view, what his outlook for the world and the Indian economy is for 2017. And if I were to ask you to list the top 3 or 4 issues that, in your mind, are likely to impact the Indian economy most of all, either positively or negatively, what would those be?
Well, I think domestically we are finally seeing that all the damage which we had seen because of macro stability being not in place has been behind us. So macro stability is not a concern at all. Second is that we are seeing finally improvement in private consumption. So because of the fact that there was tighter monetary policy and that we were also unwinding high fiscal deficit. Private consumption was weak, job creation was weak. Now we are seeing improvement in private consumption with lower inflation, a more stable expectation of inflation going forward, that the consumer is beginning to spend. So that's the, I would say, second positive. And the third is that we think from the external environment, there has been a big negative impact on exports. I think people underestimate the impact from external side that we got on growth in the last 12 months. With exports contracting, capacity utilization for manufacturing remaining weak, that was a big drag, and now that is sort of behind us. And then finally, I think the most important one is that if you do get an environment globally now where we are sort of going to be out of that balance sheet recession where developed world was going through for the last 8 years, it sort of helps for the global outlook as well as sentiment for growth for overall global economy.
And what about the negatives?
I think the risk is from global side, we would be concerned on 3 areas. One is whether the new president elect in the US takes up any aggressive protectionist measures. There are 2 areas which are being watched there. One is if there is any effort to put a unilateral tariff on imports or a border tax adjustment law. Both of them could be sort of some kind of indirect negative impact on the global trade and therefore global growth. Second is the political events in Europe, which are now back-to-back coming up in form of elections in various parts of Europe. And what that results into outlook for Euro region will also be the second risk to watch. And then finally, third is down here in Asia in form of what happens to China's growth rate and China's policy. We've seen increase in capital outflows, and that's the risk that we are watching in China, whether this increase in capital outflows results into some kind of a currency move which is disorderly. At the same time, whether that makes Chinese government to tighten its monetary policy and slow its growth aggressively. So those are the 3 risks from the external side. And from the domestic side, I think the key one is really whether...
Also, what about the risk of the commodity cycle reversing? We've seen commodity prices already go up. And wouldn't you see that as a negative for India?
Well, at this point of time, we are not seeing any real fall in commodity prices. We have seen only some bit of correction in some of the commodity prices in China, particularly copper. But other than that, as you've seen, oil has been held up quite high and all the other products have still been continuing to go up. And we do expect if China to slow down and commodity prices to probably moderate. But we don't think the price in commodity prices fall will be significant enough to kind of then start to again worry about the disinflationary pressures from China or global markets.
But won't the combination of a stronger dollar and higher oil price be a double whammy for India? A stronger dollar necessarily means a weaker rupee, and together with higher oil prices could have an inflationary impact on India.
Yeah, I think that's a valid risk. We in fact watching that one very closely, particularly on account of oil. India has seen a big benefit in terms of fall in commodity imports. So commodity imports at the peak in December 12th quarter were about 7% of GDP and have now come down to about 3.3% of GDP. So there's been a big boost to India's macro stability from decline in commodity prices. So that's a risk to watch if commodity prices rise, whether you have to be worried about inflation outlook as well as current account. And we think that if oil prices go up to, if oil is being used as a benchmark, if oil prices go up to about $65–70, up to that level, India's current macro stability indicators will be able to absorb it because of starting point of low inflation, starting point of low current account deficit. We should be able to manage a small rise in commodity prices up to $65–70 of oil. But beyond that, it will weigh on macro stability outlook. However, I would also like to mention one thing here that if you remember in 2003–06, commodity prices continued to rise, but India could absorb that rise in commodity prices and macro stability indicators were fine and growth was recovering. And so it also matters that in the background, while commodity prices are rising, why is it rising? If it's rising because of global demand, then India will be probably able to absorb that higher commodity prices because global demand and growth will mean higher capital inflows. At the same time, India is right now in a stage where it can actually see a big pickup in capex cycles. So productivity, capex and global export demand in the background will also need to be watched when commodity prices are rising.
What about the real interest rates? The fall in inflation means real interest rates in India are perhaps higher than before. So will this not impact private corporate investment?
Yeah, that is right, and that's because a part of this is in anticipation that the U.S. economy will do well, and therefore it's also resulting into expectation of higher Fed rates and the strength of the dollar. Having said that, I don't think that there should be too much currency depreciation pressures as long as RBI maintains a reasonable level of real interest rates, because in this cycle, while the US dollar is going to rise, we don't expect a rise to be such an aggressive rise that it results into big currency depreciation pressures. Currently, US Fed-based real interest rates are roughly about 130 basis points in negative territory. And then if you think from outlook perspective, we don't expect this to go up to even close to zero by end of 2017, and we expect it to go to close to zero on a real basis only in December 2018 quarter. So Fed is not going to be able to lift real rates meaningfully, that we think that the dollar will continue to rise at a very rapid pace. Well, actually, if you look at real interest rates on the basis of core CPI, they are not so high. I think the RBI has already brought it down significantly now to about 1.25%. If you assume core inflation around 5 and policy rates at 6.25, you have 1.25% real interest rates. We think that sort of level of real interest rates for this point of time in cycle is just about fine, and it's not necessarily high, Mythili.
All over the world, we're seeing a shift to fiscal rather than monetary policy. So do you think we in India should also join the bandwagon and give up this obsession with a specific number that is quite moderate to start with?
Yeah, well, from India's perspective, I think we need to not see further expansion in fiscal deficit. Fiscal deficit is already relatively high when you look at it on a consolidated basis. It's at about 6.4% of GDP. So, I will remain an orthodox analyst on this front, Mythili, for India, that we think that fiscal deficit should not really expand. Because if your fiscal deficit expands, you will get inflation back again, and then that tighter monetary policy which will be unfolding will actually affect private capex even more. So I think we should continue with the current policy approach where fiscal policy remains somewhat neutral and monetary policy has been easy, and I think now we just have to focus on actual reforms to revive private capex rather than trying to use fiscal policy to support demand.
But at a time when private corporates are not investing, wouldn't there be a case for public investment, even at the cost of some slippage in the fiscal deficit target?
Well, I think the government has been doing public capex both within the budget as well as outside the budget, and outside the budget number is actually the bigger contributor. I think that has already been happening, but to do any further expansion of fiscal deficit in the name of increase in public capex, we think would be risky, because at the end of the day, we still had just seen decline in interest rates, and that's filtering in through, and we should wait for the private sector to come forward and do the capex rather than preempting this cycle by trying to do further fiscal expansion. And mind you, history is that whenever India has done higher fiscal expansion, we have always seen that followed it with macro instability indicators going in the wrong direction. And we should not lose that success that we've had in improving macro stability indicators over the last 2 years.
So in the light of all this, what are your suggestions for the forthcoming budget that this year we're going to have much earlier than in the previous?
Well, I think the most important thing for India now to see in terms of going forward is recovery in private capex. So all the measures that can be taken to revive private capex should be the focus. I know that this black money reduction and currency replacement program has hijacked the focus of everybody right now in terms of discussion, but I think we need to get back to that original plan, that we need to create jobs, and for that private capex cycle is very important. And so I would say that all the measures should be really focused on recovery in private capex.
I'm afraid we've run out of time completely, so I'll have to end this discussion now. Thank you very much, Chetan, for joining us and sharing your views on what 2017 is likely to hold for the world economy and for us in India. And most of all, for being much more upbeat than many of us. I do hope you're right, because it's not been a very happy time for the world economy for almost a decade now, and we could do with some cheer, even if we in India have not fared too badly. Thank you very much for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us in ET Now, but not before wishing all of you a very happy new year. May the new year bring the best for all our viewers.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.